Hello and welcome. My name is Jeffrey Kennedy and welcome back to another episode of Elliott Wave Junctures. Today we're going to look at two markets that I actually spoke about last week, one of them being the E-mini S&P and the other being silver. Now, if you recall, in this episode here, or where I showed you this price chart, we were actually talking about ending diagonals at that time. And I wanted to show you this pattern because something interesting actually happened here. And actually, when I say interesting, it's something that actually happens quite often, and you need to be prepared for it. In fact, today's episode, essentially, I'm going to be talking about patience and persistence. Now, what happened in this instance here, I was looking for an ABC, and I identified wave C as an ending diagonal, and actually identified the top right here. And as you can see, what happened, somewhat frustratingly, is that prices actually made a new high above that level, and in so doing invalidated the wave count, only to be proven correct as the market did indeed sell off quite dramatically. Okay, now one thing that's very important to remember when identifying an Elliott wave pattern or counting waves real time, there's always going to be a tendency to identify a pattern or a top or a turning point before it is indeed in place. Maybe it's a result of a fast food society where things are pretty much instantaneous. I don't know. But I've noticed that it's a kind of a pitfall or a downfall of being able to identify wave patterns in a real-time market environment. Again, whenever you're counting waves real time, i.e. when the market is open and you're looking at those 1 minute, 2 minute, 3 minute price charts, there's a tendency, a very strong tendency, to actually identify wave patterns as complete before they actually are. And this is why I say quite often in futures junctures, just because you can count 5 waves up and done doesn't necessarily mean you have 5 waves up and done. One way to actually overcome that issue or overcome that problem is what I would say is demand confirming price action. So at this point here, number one, we actually had a break of the extreme of wave 4, and traditionally that's actually a point where I would say it would be safe to actually begin to initiate a position. That being the case, though, here would be your protective stop. So in this instance here, if you had taken a position to the short side on a break of the extreme of wave 4 right here, your initial protective stop would have been this level right here, in which case you would have been stopped out clearly. Okay, which brings us to the second point with respect to today's episode or today's lesson. Just because things don't unfold precisely the way you expect them to doesn't mean you're wrong. Okay, now a great example is my weekend. Okay, this weekend didn't happen or unfold exactly the way I originally anticipated my weekend to unfold, but it was a wonderful weekend. It was a wonderful, beautiful weekend. Okay, my point being here is the pattern we identified in the S&P E-mini, we identified, bottom line, the move up from that extreme here as a counter trend price move, as a corrective wave pattern, meaning that once it was complete, it would be more than fully retraced. Now, did it end here like I originally thought? No, it did not. In fact, we actually went up a few times and made moderate new highs. But overall, the pattern did indeed unfold what we in the way that we originally anticipated, meaning that this move, this advance was indeed going to be more than fully retraced. The only problem was it didn't unfold exactly. One of the key things to remember when applying the wave principle, again, in real time, is number one, not to rush the wave count, but number two, you must be adaptive. Applying the wave principle in a real-time market environment demands that application of the wave principle be very fluid. You have to allow the market to be the market. Okay, so in this instance here, even though we did see the moderate new highs that we did see the following few trading days, none of that showed us any kind of evidence. None of that negated our overall outlook that this was indeed a counter trend move and that it was going to be more than fully retraced. Now, even if you had gotten initially short here and been stopped out, well, here was a few other opportunities where this area right here where we say broke the trend line and went back up in 3 waves, doing what I will often refer to as a pullback. And also, too, small consolidation right here on the shorter term time frame. That was a small 3-wave price move. So there was still plenty of opportunity to jump in on this position, even though if you had been premature and identified the pattern complete. Also, too, as it stands right now, well, there's further decline coming here because, as you know, with respect to an impulse wave, Well, you need 5 waves to have an impulse wave. Waves 1, 2, 3, 4, and 5. And the best I can see here is you might have waves 1, 2, and 3 in place, which means you still need waves 4 and 5, which means you're still going to be going lower here. But again, with respect to applying the wave principle in a real-time market environment, a few things you must remember. Number 1, you must be patient. Try not to identify wave patterns prematurely, and the best way to do that is by demanding that confirming price action. 2, be persistent. If you see a price action unfold and you believe this to be a counter-trend price move and no evidence to the contrary has developed, continue to embrace it as a counter-trend price move and just simply, again, watch and wait. Although one thing I say quite often is ready, aim, 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 and then fire. A lot of traders like to go ready, fire, and then aim. That's not the way to do it. Now, let's go ahead and take a look at a few more markets here, and then I'll go ahead and sign off for the day. But here's now the interpretation I would have actually utilized, where you simply still had that ending diagonal formation, that ending diagonal shape. It simply ended a little bit later here. Now, again, with respect to the current substructure, this is a small minor counter-trend fourth wave move. We're going to be going lower. It seems to be kind of a no-brainer at this point. And again, this is the E-mini S&P 500. But the 2 markets I wanted to take a look at were the silver markets. Now, if you recall, with respect to silver, we were working the idea of a contracting triangle, and we can still work with that idea even though we did see a nice move to the upside last week. Now again, with respect to the contracting triangle, the formation, the actual pattern, it is a pattern, it is essentially a sideways price move within converging trend lines. Now in this instance here, I'm utilizing waves A, B, C, D, and I'm going to identify wave E as an expanded flat. Notice here the high of the move comes in at 28.68. That's still below what I would consider to be critical resistance at 28.76. So as long as 28.76 holds, this interpretation is still very much applicable. But again, what we need to actually see is price action to actually penetrate, say, this 27.17 level or this 27.35 level. Again, this would be our confirming price action. We need to see daily closing price action below, say, 27.5, 27 here to really clear the way for lower prices in this market. Otherwise, what's going to happen is this market is just going to continue to be range bound, and range bound markets are markets that I tend to stay away from because I don't like being stuck in a trading range. I like to be long when markets are moving up, and I like to be short when markets are moving down. I like to be on the sidelines when markets are moving sideways. Now what we can do again is to update our current labeling here. And again, for a better idea of what's going on here, please check with Steve Hochberg's work in the short-term update or Mike Draculich's work with respect to the Specialty Services Metals product. Now, this is the way I'm currently looking at the short-term structure. And again, we can go ahead and clearly identify, I believe, 28.76 as critical resistance for this interpretation. We don't want to see that level give way. Otherwise, we'll most likely be looking at an A triangle B C formation where we push up to, say, 29.5 or even $30 an ounce before we push lower. Now there was one more market I actually looked at, and we'll call it a day after this, is the ticker symbol was SLV. This is an exchange traded fund, or this is an ETF. Now in that wave count, that what I actually showed you was this price chart. But notice what happened with respect to the current move to the upside. We actually went to a high of 27.89. Well, that's actually above the C wave extreme of 27.86. Now this goes back to, again, directly to today's lesson. The move above 27.89 invalidates the interpretation. As you know, we had waves A, B, C, D, and E. Wave E should not move above 27.86. It did, meaning that this is not the correct interpretation. But does it mean that this move here will not be more than fully retraced because it's a very much of a corrective wave pattern? This is a corrective price move, bottom line. I still believe it's a triangle, and in fact I'll go ahead and I'd continue to identify it as a triangle, as you can see here. In this instance, we can go ahead and look at 27.89. Ideally we'll view that as a key resistance, but the critical resistance mark comes in at 28.09, the extreme of wave A. So what I'll simply be looking for now as we move into the next few trading days are waves D and E. I see the price gap right here, very attractive target for wave D. One more push up, but again, if we can keep prices below 27.89, better yet 28.09, then we can continue to view this move here as very much of a corrective wave pattern, i.e. the sideways price action. So even though prices may not unfold precisely the way you think they should, doesn't mean your analysis is incorrect, and it doesn't mean that there's still not a trade there. It just simply means that you need to be patient, look for that confirming price action, be persistent, and continue to look at what's going on in front of you and not get too wrapped up in things. And just again, as if the market's moving sideways, as it is, say in the silver here, we're going to continue to look lower. That about does it for today. Thank you very much and have a wonderful evening.